Hello guys, welcome to the live session. I'm going to record my Call Condor setup live today just to show you that how we are going to determine the support and resistance level using the option chain open interest analysis, and we will take the position of a Call Condor. So now the time is 9 o'clock in the morning. So the market is about to open for a new weekly expiry, the first week of June.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Let's see the option chain. So for the option chain, we go to the NSE website and then we select 3rd of June. So we come to closer to the ATM prices. We see where the support and resistance level are available in the option chain. So what we have here is the support level. We have to see the put option chain open interest, and for the resistance level we will see the call side open interest. So if you see for the put side right now, this is basically like the yesterday's close positions. We will be taking our positions somewhere close to 11 o'clock in the morning. So right now the highest open interest in the put side is somewhere about 15,300, but if you see the open interest or what is available as a outstanding contracts, so that one is at 15,200. So this is basically quite away, like consider 1, 2, 3, 4, like about 4 to 5 strikes away from the spot. So right now the SGX Nifty has already almost close or little bit it has crossed the Nifty's all-time high. So we consider this as a bullish momentum in the market. So let's see that, okay, we will go and take a position, a sell position at 5200, and we will hedge it with the ITM buy at 15100. Basically, we will be looking at the call side. We will be taking the position in the call side, but for the support levels, you have to see the put side, okay? So call side, we will take 15200 and 15100. Means there is no need to see the OA on the call side, because for the support we should always look at the put side. Let us see the resistance levels where it is. So right now for resistance level we will see the call side. So for right now you will see the highest open interest is, the volume is somewhere around, it is close to ATM, 15,500 is where it is there. But if you see the outstanding contracts, it is somewhere around 16,000. It is quite far. So the market seems to be a bit more bullish. But if you see in between, if you see the open interest is quite high in 15,700 and 15,800. 15,800 a little bit less, because 15,800 we are going to do the hedge only. We are not going to take the sell strike. We will be taking the sell strikes at 15,700 and we'll be taking the hedge buy strike at 15,800. So if you do these, let us go to our option Call Condor. So we have our Call Condor here. Already I have populated those strikes with yesterday's premium. So these premiums will change. So with this, what we see is right now we are going to pay 71 points, little bit higher because the market is very bullish. So the ITM options we will be paying a bit more, and for the OTM options we will be collecting a bit less, because we have a good amount of 500 point difference between that. So the maximum loss we will get if it breaches 15,800 and 1500. We are going to lose 21,500. The maximum profit we are going to get 8,500, somewhere around 8,500. So the upper and lower break-even points are 15,728. This is way above the all-time high of Nifty, and the lower break-even is 15,171. Means 15,200 seems to be a good support. So the break-even is little lower than that. So we consider currently this range is a good range. Means if it express between these two ranges, we bound to make at least 1 rupee, as I explained in the Call Condor strategy video. Our risk reward ratio is a bit poor, but it is still better than the regular iron condor. So 1 is to 0.4 is not a very good risk reward ratio for 500 point range. It needs to be somewhere around 1 is to 0.5 to 0.6. So it is little bit less, but we will wait for the actual market to open so that the premiums will get updated. Then maybe we will get a better RR. If the RR is not coming okay, let us see. We will wait for an opportunity for today. We will get a good RR. So once I take the position, we will update the margin. Automatically, we will get the ROC updated. We will update the spot, weeks, and the date of entry. And further, any adjustments are made, I will be updating the adjustments here. So you can come back and check. I will be posting it in the group also, but you can come back and check. Quickly means we will go through the margin requirements for the trade. We will go to Zerodha. This is the account I have in Zerodha. So we will go and do a basket order here. So we go to the basket. So we have a Call Condor Nifty. Let us edit these. We will put the strikes here. 15,100 on June 3rd expiry. We are going to buy. I'm going to do 4 lots. So we are going to buy. I just simply put the market order. We will know the margin requirement. Then while executing, we can always change it to the limit order. So we take 300 quantity. So what is required is about 88,560. This is the cash required to take the position because we are doing a in the money option by using the amount is quite high. Okay, we add this one. Then we go and do the sell strike. So that is 15,200, 3rd June expiry. So we will go and sell this. So the quantity is 300, and you see the margin requirement seems to be a little less because we have already done the buy. So the total margin what is required to take this two is about 1,16,000. This does not reflect the correct one. Let us see, because normally to take this one it will not require 1,16,000. It will require a little less. So now we are going to do the 15,800 buy. So 15,800, we go and do 300 quantity market order. This requires very less because this is a out of the money option. So this requires only 3,000 rupees. Then we will go and do the sell of 15,700. Because always whenever you take a spread, you first do the buy, then you do the sell, you can get the margin benefit. So here also the quantity is 300, and we go with the market order. You see, the margin required is very, very less for the OTM option because we have already got the buy leg inside. So now you see that to take, sorry, this is sell, sorry. This is a sell. Okay, now the margin required is about 5 lakhs, not 5 lakhs, it will be less. So together means when you take all the positions together, right now the margin required is just about 2 lakhs. So this confirms that the Call Condor what we are making, I am making a 4 lot Call Condor. So 1 lot it is somewhere about 50,000 rupees. So for 4 lots I am going to pay 2 lakh rupees. So we don't execute it now because the market is just open, the pre-market has finished. So the original margin required is 2,78,000, but the final margin what we need is about 2,05,000 rupees only. You say 2 lakh. This margin is dynamic; it will keep on changing. So you keep about 15,000-20,000 more than this in your account. I think you should be good to go till the expiry, unless until the VIX shoots up or the market moves closer to the lower break-even or upper break-even. This margin requirement will be somewhere plus or minus 10 to 15,000 only based on the NSE margin adjustments. Okay, so we don't execute it; we just keep it. We just close it; it is there. Means whenever we want, we can come back. While executing, we will go and execute with the limit order. We will not be using market order. Sometimes, like if the spread is very low, better to go with market order because we want the buys to execute first before executing the sell. Because if you do the sell, the order might get rejected because of the margin, non-availability of margin in the account. Because when the sell is executed for 4 lots, you will require a huge margin, somewhere about 5.5 lakhs will be required. That much cash is there, you can do without any trouble. If that cash is not there, so better to execute the buy legs first, then you can go and execute the sell legs. But better to use the basket order with market order option, so everything will get executed without any issue. But when we do the market order, you take care of the spreads in between. If you see the bid and ask spread right now, it is not updated. So when the market opens, you will see what is the bid is what the person is offering, he wants to buy, and what is the sell is the person is offering a price to sell. So this bid ask spread is what in the ITM options it will be quite high. So we will look for a spread of 1 to 2 rupees. So 1 to 2 rupees means Nifty per lot 1 rupee is 71 point is 75 rupees. Okay. So if we are having like I'm doing 4 lots, so for 1 point of difference, I'm going to gain or lose 300 rupees here. So we need to be careful here. So we need to take the positions when the spread is less. Means if it is around 1 rupee, normally it will be about 1 rupee to 2 rupees. So sometimes it may go to 4 to 5 rupees also. If it is not very liquid or deep in the money, it may go to 4 to 5 rupees. That time, if you execute a market order, it will have a huge slippage which will affect your profit and it can increase your loss also. Okay, so we need to be careful here. So the setup is already here just for your information. I'll just go to maybe like I'll do the buy about both the buys. The margin does not change because it calculates for the whole position only. So just for your this one. So we have a bull call spread 15,100 buy, 15,200 sell. This is a bull call spread, and 15,700 sell and 15,800 buy. This forms a bear call spread. So if the market is going to expire anywhere between 15,200 and 15,700, we will get, how much we will get? 8,475 rupees. If the market breaches either 15,700 and 5,200, we will start making loss. The maximum loss will come when the market reaches 15,800 or 15,100. This is a 700 points range for 5 days. It is for a week. So we don't know means what will happen. Let us see if the market is going away from our view, then we will start doing adjustments. The adjustments video will also be included. It will be coming next because I'll be doing like every day I'll be doing some view, and then if any adjustment made, I'll make the video and totally everything will become one video. Okay, so let's see means how this goes, and I'll keep you posted. Hello guys. So the market has opened. So the time is somewhere around like 9:30 plus. So the market has opened. So here what you see 12 o'clock is basically Singapore time and outside India. So just 2.5 hours you have to minus for the Indian Standard Time. So the time is about 9:30. So the market has opened and the market has gapped up very well. So you can see the market has gapped up to about 3/4 of 1%. So it is 0.75. So now we see the option chain. In the previous section, I had analyzed 15,200 and 15,100, and that is almost still holding. So you can see 15,200, the number of open contracts are getting added. But the surprising thing is the puts are being written in, you can see change in over The puts are being written at 15,400. 15,400 is almost ATM strike. Means the outlook for the market today is very bullish. So, but we are going further inside. Means when like consider that 15,400 is gaining more contracts. Means this will become more as a support. Means the market in this week it may not reach 15,400 also. So our 15,200 and 15,100 will be relatively safe. Right now you can see that 15,100 is trading at about 346 rupees call option, and 15,200 is trading about 465. So what is our rule? Pay 80 points for a 100-point difference. You can see it's almost 80 points. So we are still within the range. Even the market has capped up. We are still, the range is still holding. The premiums are still holding. Whatever is increased is still there. So 346 minus 265. So you are getting somewhere about 19 points. So you are going to pay about 81 points, so you are going to gain 19 points. So if you see our Call Condor example of the strategy video, the setup was almost similar. So we are getting almost a similar setup. And on the resistance, on the OTM call side, we have seen 15,700 and 15,800. Right now also you can see there are more calls are being written at those strikes. You can see the numbers are quite high. Okay, 16,000 would definitely have more because this is a 500 round strikes. This will definitely have more, but this is also a bit alarming because you see the outstanding contract number is quite high. Means the view is very bullish. So we can still take the position, and then we can still do the adjustments if the market goes up by another 150 200 points. So our 15,700 might get into trouble. So that time the premium would have been somewhere around not 83 because this has a lot of time value. So that time if it goes in another 2 days, this premium would have doubled or it will be somewhere about 60 rupees. Okay, somewhere around that level. So but by that time we would have moved the 15,100 and 15,200 spread very close, maybe like 15,400, 15,300. That kind of levels would have moved. In that process, we would have booked the profit. Okay, let us see in the orders, basket orders. Let us see what is the margin required for this. So right now, maybe about like, yeah, it's about the same margin. So let's see. Okay, we are still having 346, 263, 265. You can see now. I'll show you the bid and ask difference. You see the bid and ask difference here. It's about 1 rupee. 1 rupee in a volatile market. 1 rupee is quite good. Now it has come to 2 rupees. So 1 rupee, 2 rupees like that. If anywhere now you see it is 2 rupees. Anywhere it goes beyond 2 rupees. So it is bit difficult. Whenever like it is like 1 rupee or like that, you can quickly execute the order. You see 15,200 also somewhere it will be similar. You can see the bid and ask spread is somewhere about 1 rupee to 2 rupees. So this is the spread you have to execute. Means when you sell, there should be someone who will be buying. So when you do a market order of sell, you will be executing at the bid price. When you are buying it, you will be executing at the offer price. So you have to be very clear on that. Many people would get confused. Means when you say this is the sell price is there and this is the price, the sell will get executed. No, the sell will execute at the market price. If you do the sell, it will execute at the buy price. Like for example, you are going to buy. I'll put it as example. If you are going to buy 15,100 contract. So when you go and execute a buy order at market price, so where it will get executed? Not here, it will get executed here. Means you are paying high for buying the option, and you are going to sell what? You are going to sell 15,200. So when you are going to sell, the moment you execute the sell, you think where it will get executed? Just think about it. If you are selling, means if you are selling means you will be selling at the buyer's price, means the offer is always higher than the bid. So when you are selling, you have to see the bid price when you are selling with the market price. So it will execute at the market price. It will not execute at the offer price. If you put a limit order, okay, it will show up in your offer, and whenever the price comes there, the order matching will happen and it will get executed. Okay, so this is the bid ask spread I'm talking about. Now the bid ask spread is quite good, 1 rupee only, so we can still go and execute our positions. Now you see it's about, it went just momentarily 3 rupees and then it came back. So now it is about 2 rupees. So this is okay, 2 rupees is still okay, because 15,100 is almost, it's a deep ITM. Means you can see that it is at least 8 strikes deep in the money, and 15,200 is about 6 strikes in the money. So the whenever like you are going in the money, you have a good volume also, like 63,000 contracts is good, but not like everything is getting executed. Means the execution is slow in ITM. But the same way, if you see OTM, it will start pushing like anything. You can see the OTM how it moves. Every time you keep on, every second you will keep on getting the change in the OTM, but on the ITM options you will find the movement is very less, the volume also will be very less, because this requires huge money. ITM is not everybody's cup of tea. Normally the option buyers, uninformed option buyers do not buy ITM options. Buying ITM options are good, but people do not go and buy ITM options because the cash what they have might be very less. Because to execute this position, you say consider 350 rupees. So if you say 350 rupees, let us take the calculator, a simple one. So if you say like 350 rupees, you are executing one contract only. So you will require 26,250 rupees. This might be the entire capital of a person. Yeah, the person, if he is doing option buy, this might be his entire capital. So he will be looking at going and buying out of the money options. So out of the money options, if you see that if someone wants to buy 15,800, this itself is high actually. People will go and buy for 3 rupees and 4 rupees, far out OTM they will go and buy. So 15,800, we will see that it is at 1270. So it is 12.7 multiplied by 75. I'm just giving it for one lot. So it's about 1,000 rupees. So people can do like 5,000 rupees if they want to put, they can go and buy 5 lots. So that 5 lots, that 950 rupees is option seller's gain, because if it goes to 15,800, okay, consider option buyer is lucky. So the option buyer winning rate is quite less, but if he wins, they win bigger. So right now also, I think the market has gone up. So right now we are getting about 17 points. 17 points we are going to get, means we are going to pay about 83 points. So now it is widening. So here also, like, okay, we explained the ITM one, I did not explain the OTM ones, but OTM you can see means 26 rupees is what 27 we get, and we pay about 13 rupees as a debit for a hedge. So here we are getting somewhere about 13 to 14 points. OTM options is very easy, means you can always get that, but only in the ITM you have to be careful. So now the beta, the difference is increasing. We need 20. So when the 20 comes, we will go and execute that. We will have slippage, 1 or 2 point slippage will be there, but that's quite all right, because that will eat away into our profit. But in this strategy, when like we execute, we'll be executing it in that way. So now the market is going up. So that is why means this is going further deep in the money. So we are not getting the enough premium difference what we are looking at. Means we are looking at 20 points. Now we are at somewhere about 15 points. So means we don't want to pay anything more than 80 to 83 points, because the profit will be less. It's at the expiry, we are just looking to take like a 12-13 points is not good. So it is not a good risk reward. The risk will be still higher, but the reward will be lower. So we may have to wait for it. So let us wait for this. So when I take the positions, I'll update you. Thank you. Hello guys. So the market has come down a little bit after hitting the all-time high. So now it is trading at around 15,420. Still we are waiting to get our premiums. So you can see 349 and 264. So 64 minus 49. No, it is still not, we are not getting enough premiums because we will be paying 85 points, means to collect 15 points. So this is not a good risk reward. So we will still wait for it. Still the time is somewhere around 10:20. So let's see whether we are getting anything better. Now bit improvement is there, so 66.50. So we are getting about 16 points, means the market needs to come down a bit, maybe like bit below 15,400, so that the premium difference will be suitable for us to take. So we will wait for that. Let's see. Hello guys, welcome back. So now the time is about 10:30. So now we can see the range has shifted to 15,300 and 15,200. So you can see 15,200 had a lot of OI, but now so much of put writing is happening at 15,300. So accordingly, like we will also change our range to 15,300 and 15,200. It's a bit risky because we are at the all-time high, and if the market crashes, we may have to do adjustments. But still, like we will go ahead with the trade, and we will keep the risk reward up about 1:1. So let's see, means how the premiums look like live. So 15,100 will get deleted, so we will have 15,200, 15,300. Here the RR will be quite high. Let's see, means how it works out. So 15 to have 273, 274 to pay, and to collect 198. So 273 minus 198, 97. So we are going to pay for 75 points, means we are going to collect 25 points if the market expires above 15,300. Still means the out of the money calls, we are still going to keep this. We are getting a good premium here. About we are going to collect about 13 points. So 13 points is a good premium to collect on the bear call spread. On the bull call, we are going to pay only 75. So the risk reward will be quite good. Let's see. This is 272 and 197. So this will be 15,200 and 15,300. So here we'll still keep the premium same. It has not moved much, so we'll keep it same. So this one is 273. This one 270 and 195. It's still better. 270 and 195. So now you can see the risk reward is pushing up like anything because we are coming close to the spot. So now we have, for 4 lots, we have a max profit of 11,500. And if our view goes wrong, we have a max loss of 18,500. So still the range remains a bit wide. So 262 is a bit risky because I would ideally like this to be below 15,200 because 15,200 has an enormous support, and 738 is okay because the market shooting up to 738. I still think the probability is less, but the market can surprise us. Let us see, means how it pans out. Now what we will do, we will start updating our orders. I think now is the time we will take our position. So we will delete the bull call spread. We will do it again. we will still keep the bear call as it is. So we have 5200 is the buy. So 5200 is the 3rd June. So 300 quantity is a market buy, and it is, we need less money, means we are coming close to the spot, so the premiums will be lesser. It is not very deep in the money, so the premiums what we pay will be less. So it's about 81,000. Then now we are going to do 15,300. This is a sell leg. So 300 quantity at the market. So the margin required will be about 59,000. It will be less because we are coming close to the spot. So now, so it's a sell. See, again I make the problem. It's a sell. Okay. Modify. So now we move the bull call above 15,300. And the buys also needs to get moved. So 2 sells, 2 buys, so it's 2,05,000. So it is more or less the same. You see the margin is dynamic. Every time you refresh, it keeps on changing because of movement in the market. So let's see, it's a market order. We have to make it as a limit, or we might execute market because we are very close to the spot. We might execute market. Okay. 73.98, about 25 points, still 25 points. You see, when you buy, you will buy at the offer price, and when you sell, you will sell at the bid price. So it's reducing a bit. So 73, 97, 98, it is still okay. It's a good spread. So here it is 24.4, 11.4, about 13 points. 13 points is good to collect here, because for the OTM, it will be 5 paisa to 10 paisa difference. You see 5 paisa difference, 10 paisa difference means there is no need to worry much about your spread. The OTM will be 5 paisa to 10 paisa spread. It will not move more than that because it is OTM. Only you have to worry about the bid-ask spread in the ITM strikes. So 198, you see the bid-ask spread reduces like anything when you are close to the spot. Here it is about a rupee, here it is less than a rupee. It's about 30-35 pies. So this is good, but the setup is a bit risky, but still we will go ahead. This is for education purpose. If any adjustments I am doing, I will be informing you. 73. See, I'm going to execute a market order here. So we have 200 is your buy, 300 is your sell, and 800 is your buy, and 700 is sell. You make in this order your margin benefit. You will get, because first you are doing a buy, then sell. Then you are doing a buy, then sell. So this is how you will get the margin benefits. So now this is the time. Let's execute. The moment it executes, everything is a market order. I prefer to put a limit order since the bid-ask spread is very less and I don't want to get a peak margin penalty or anything. So I just execute everything in the same order as market order. You can choose to do a limit order, but be careful. If the sell is getting executed first, then your margin requirement is quite high. It might get rejected, or you will get a peak margin penalty from your broker. Okay, let's execute this. Zoom. Done. You see, this order 15,800 has failed. The buy of 15,800 has failed. So let's see what happened. I have to do it manually. 15,800 is a buy. 300. Let's see the positions first. Yeah, 800 has not executed. Market. Still same. You see, we collected 13 points here. Almost 24 points. It is still good. Let's update the premiums in our Call Condor Excel sheet. So 274.95 and 199.07. 274.95, 199.07. So for the 4 dots. And the next one is 2430 and 1130, a simple one. So 2430 and 1130. Boom. Almost the same. We are at 0.6. Our range is still the same. The cost is 18,864, which is also going to be the maximum loss. And if we get the maximum profit, we will be getting 11,136 rupees. And the margin we all have seen, it is 2,05,300. This is the margin. We keep it as it is. So the return on capital works out to be, let's see where the spot is. This is 15,430 and the weeks. So here we have everything here. Let's see, 15,430 and the VIX is 18.82. The spot is 15,430 and the VIX is 18.82. So when did we enter? Let us copy this. So we entered 28 and let's see the time. It's not 10:10. Let's see the order time. So orders, we'll see the order time is about 10:40. The last order was 10:40. So let's say 10:40. So 10:40. You see, when we are coming at about 11 o'clock, we are getting the correct range and correct premium. This is why even during the training video, I informed that you wait for the premiums to come and the range to set in. So once you get the range correctly, I think most of the work is done. Let's see what it shows now. See, we still have a huge amount of open interest here, change in open interest, and the huge amount of open positions or the outstanding contracts is about 33,000 and 32,000. To breach this one will take time because huge amount of puts were being written, means the market to breach 15,300 on the downside is unlikely. It may happen. When it happens, the OA is dynamic, it keeps on changing. So you have to monitor the OA changes here. Means the moment you see that the 15,200 is going up, then you are in trouble. So you may have to roll down this a bit and then you have to roll down your sell strikes also. Okay, we are sell strikes, we are okay with it. It's like we still have the highest OA at 15,700 and the next highest OA at 15,800. Here in the OTM, I think we are okay with it. In the ITM, we are a little bit close, like 15,300, 200. I would have preferred 200 and 100, but we were not getting the required premium. We were getting what? About 16 points, 15 points. The market is hovering around. The premiums are not melting. We are not getting the required premium. So our risk reward ratio is not a favorable one. That's why we just moved our range to 100 points closer to the spot. So we are at 15,200 and 15,300. This is a bull call spread and we paid out about 75 points. We are trying to collect 25 points. So the strategy is Call Condor and your payoff looks like this. Again, I will explain. We paid 275, close to 275 rupees for a ITM call buy, and we collected about 200 rupees for a in the money call sell. So together what has happened, we have paid a net debit of how much? 275 minus 200, so 75. So we paid 75 points and we are trying to collect the remaining 25 points because we paid 75 points for a 100 point strike difference. So the remaining 25 points is what we are going to gain here. And on the bear call spread for 15,700 and 15,800, we collected about 13, exactly 13 points we collected, very ideal, 13 points we collected. and together what we are trying to get is 25 plus 13. We are trying to collect about 38 points. Means you can see net paid is about 62.88. So you say 63, we are trying to collect 37 points. So that 37 point is going to be our maximum profit. If we lose, we will be losing 62 points. So the 62 points, the maximum loss is 18,800 rupees. So the risk reward ratio is 1 is to 0.6. This risk reward you will never get in Iron Condor. Okay, Iron Condor will always be hovering around 0.3, 0.4 kind of levels. For this call condor, if you see the equivalent Iron Condor, you might get something close like 0.45 to 0.5, but never 0.6. And the margin required will be little bit higher. Like today morning I have posted it in the Telegram group, the differences between the Call Condor and the regular Iron Condor. I hope everybody is aware of that. The difference is minor, but if you scale up in the lots, like I have given it for one lot, the risk reward is 20% higher in the Call Condor. So, and the margin requirement is also bit less, but again means for this we have paid out close to 82,000. Means if you don't have 82,000 in your account cash, you cannot take this position. But in Iron Condor, you don't need that because it's a credit strategy. You will be dealing only with OTM options, and you may not pay huge amount of money for that. So this is what we have done now. So let us see how this position pans out, and if I am going to do the adjustment, I will be posting that in the group also. Now live, how I am going to post it, you will come to know. I'll do that now. So you zoom, say 90, no, still. Okay, we keep this, then we take a screenshot. Do we make a screenshot? Done. So we did this, done. Then we go to our Telegram. FTBN. So we come here, then we paste this, we say Call Condor, setup for 03 June 2021. Expiry. Done. This is what I do every week. So today you all have seen how I am going to do this and how I selected the strikes, what premiums I am going to look at. This is nothing different than what I have explained in the training video. Now you have seen how I have done it, and I hope the live session was helpful, and I'll see you again in the, you can see the position. The position keeps on moving. Don't even worry about if you are having a loss. Or you see when we took, it was 15,430. Now you see the market has come down. But you see, probably we might get the premiums. This is what we call luck. Probably we might get the premium at 15,100. Let us see now what we are getting. Because some time has passed, so some decay would have happened. So let's see 15,100. So 63, 60, 62, 45. So we are getting somewhere about 17 points. Okay, still there. 17 points is also good, but still there. But this is the LTP. So if you see the, yeah, you see 47, 63 and 47. Still not good. Still not good. So I think the range what we have taken is okay. Let's see. So what we have taken now, it is 63.90, but still okay. Means we are having a loss in the bull call spread and we are having a minor profit in the bear call spread, but that is perfectly all right. If the market is hovering around like this, normally the decay will happen and we will start seeing profit. It's not immediate, the profit is not immediate, but it will start moving. And this is ITM, so the movement is not very frequent, but this is OTM, it will change every second. The ITM ones change like every 15-20 seconds. Sometimes you are very deep ITMs, even for 5 minutes the price does not change because no order would get executed for the price, so it will not change. So now you see it's reducing. So this is the way how we do it. So right now we are at about 500 700 rupees loss. That does not matter, means this is like the MTM, you don't have to see the MTM because the ITM moves slow, so you don't have to see too much. If the market shoots up, then what we do, we move this 15, 200, 300 closer to the future spot. And this 15, 700, 800, we would like to still keep it because we have already collected a credit. We don't touch the tested side. We will be touching only the untested side. We will be moving it close to the spot. This is a standard Iron Condor adjustment. Let's see means how this pans out. And I hope this session is helpful to you. Now you will know exactly means how the Call Condor setup premiums are done, how to choose the strikes, how to study the option chain for the support and resistance levels, and how to execute the order. In Zerodha, you can do it in any of your broker platforms, but I have an account with Zerodha, so I'll be doing most of my call contracts here. I have an account with 5 Paisa, but there I just do a strategy which complements this. If consider the market is shooting up, I might do a bull put spread in Zerodha in 5 Paisa account. If the market is going down, I might do a bear put spread or a bear call spread there because the credit strategy. So I'll do a bear call spread in 5 Paisa account. So just compliments, just trying to collect another like 1,200 rupees there. Means these small money, this will keep on adding. And on top of this, when in this strategy, when we are close to the expiry, on the expiry day, if the market is somewhere in the middle between these two strikes, I might go and sell a MIS or MIS order of 15,800 and I might go and sell 5,200 also. Means the premium will not be that will be PE, that will not be CE. So I'll be selling 15200 PE and 15800 CE. That's a short strangle. I'll do it on expiry. That strategy, short strangle, we have a big expert in our group, Shreyas. So he already explains in his setup, in his expiry trades. So I'll be doing it for a premium of about 1.5 rupees to 2 rupees, not more than that. So we can do that. So 2 lakh rupees is the margin we blocked for this, and I still have enough cash, means because out of these 2 lakhs, 1 lakh only will be taken from my cash position, another 1 lakh will be collateral. So I still have a lot of funds, free funds available in the account. So I may not show what funds I have, but I have enough funds. So you also keep at least 10 to 15,000 rupees more for this order to play out safely. Thank you very much for watching. Goodbye.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.